So in terms of lessons that I've learned over the years, I think the one that sort of struck me the most is one that I learned very early on. So I used to have this perception that investors have a very high degree of certainty about the future, and that you invest because you feel like you have certainty about certain outcomes. And I realized very quickly that in this world, in the things that we do, uncertainty is always there. You can't get away from it. And if you fool yourself into thinking that you have an investment position where you have absolute certainty, that usually doesn't work out so well. The way I deal with that now is I approach every situation. So, whether it's a view on inflation, whether it's a view on interest rates, whether it's a view on the credit cycle, with establishing a base case and then a range of uncertainty around that base case. And then I ask myself, okay, what's being currently priced into markets? Are markets pricing in this scenario with a high degree of certainty or a low degree of certainty? And in doing so, I can identify asymmetric investment opportunities. When I talk about asymmetric opportunities, what I mean is situations where you can put on a position where the possibility of loss is small relative to the possibility of gain. And that typically happens because of some sort of market inefficiency. So it might be structural, so it could be regulation that compels investors to behave in a certain way, or it could be because of extremes of sentiment. And so at times you get very, very extreme sentiment, and that results in a particular scenario being priced either with an extremely high probability or an extremely low probability. So to then go in and bet against that, you have favorable asymmetry, because if it's already heavily priced in and you're betting against it, well, if it happens, the downside is not very much. If it doesn't happen, there's a lot of room for surprise and your upside is great. If I look at interest rate volatility markets, I see that now. Even after the little spike that we've had in recent weeks, vol is asymmetrically low in my mind. So there's a lot of benefit there to positioning for increase in rate vol. The other one that I see is in the shape of how markets are pricing forward inflation expectations. So what I feel is that markets are simply extrapolating the current history of benign low inflation out to the very far future. So this scenario that low inflation will remain for a long time is very heavily priced into markets. And therefore taking the other side of that by positioning along that curve looks to be an asymmetric, a favorably asymmetric opportunity.